Hey everyone, I'm Eve. Let me ask you a question. When you get on a roller coaster, do you spend the entire ride screaming in terror, gripping the safety bar until your knuckles turn white, trying to predict every single twist, turn, and drop before it happens? Or do you strap in, throw your hands in the air, and trust that the ride was designed to bring you safely back to the station? For most of us, the stock market feels less like a fun amusement park ride and more like a terrifying, unpredictable beast that wants to take all of our hard-earned money. This is a very common feeling. It's called market timing anxiety. It's that knot in your stomach when you have some savings sitting in your bank account earning zero interest. You know you should invest it to protect it from inflation, but a voice in your head whispers, "What if I buy today and the market crashes tomorrow? The S&P 500 is at an all-time high. Surely it has to come down soon. I'll just wait for a 10% dip, and then I'll buy." So, you wait. You watch the financial news, you stare at the charts. The market goes up, and you feel a pang of regret for missing out. The market goes down, and you feel a sense of relief, thinking, "See, I was right to wait." But then it starts going up again, and you're back to square one, paralyzed by fear. This cycle is exhausting, and more importantly, it is incredibly expensive. Today, I want to help you break free from this anxiety. I want to show you why trying to outsmart the market is a fool's game, and why the simplest, most boring investment strategy is often the most profitable one. To do this, we need to change the way we look at the stock market itself. We need to stop seeing it as a casino and start seeing it for what it really is: a powerful wealth-building tool that rewards patience and punishes panic. The root of market timing anxiety is a misunderstanding of volatility. We see the daily ups and downs of the S&P 500, and our brains interpret those drops as loss or danger. But volatility is not the same as risk. Think of it like this. The stock market is like a person walking up a long, gradual hill with a yo-yo in their hand. The person represents the overall economy. Over the last 100 years, through wars, recessions, pandemics, and crises, that person has continued to walk up the hill. The economy grows. Companies invent new things, they become more efficient, and their value increases. The yo-yo represents the stock market's daily prices. Sometimes the yo-yo is above the person's hand, and sometimes it's below. It spins wildly, going up and down in the short term. If you only focus on the yo-yo, you're going to get dizzy. You're going to panic when it drops. But if you step back and look at the person walking up the hill, you realize that the direction is always up. The daily movements of the yo-yo are just noise. They are a distraction from the main event. The problem with trying to time the market, trying to buy when the yo-yo is low and sell when it's high, is that you have to be right twice. You have to be right about when to get out, and you have to be right about when to get back in. History shows us that even the smartest professionals on Wall Street, with all their data and supercomputers, cannot do this consistently. In fact, most of them underperform a simple S&P 500 index fund over the long term. If the pros can't do it, why do you think you can? When you sit on the sidelines waiting for a crash, you are missing out on all the days when the market goes up. And the data is clear. The biggest gains in the market often happen on just a handful of days. If you miss those few days because you are waiting for a better entry point, your long-term returns will be drastically lower. There is a famous saying in the investment world: time in the market beats timing the market. It means that the single most important factor in your investment success is not your ability to predict the future. It's the amount of time you let your money compound. The best day to invest was 20 years ago. The second best day is today. It doesn't matter if the market is at an all-time high. If you are investing for the long term, for 10, 20, or 30 years from now, today's price will look like a bargain in retrospect. So how do we cure this anxiety? How does a fuzzy monster like me, who gets scared of loud noises, become a confident investor? The cure is simplicity. The financial industry wants you to believe that investing is complicated. They want you to think you need their expensive advisors, their complex hedge funds, and their secret strategies. They profit from your confusion and fear. But the truth is, the most effective investment strategy is also the easiest to understand. It's called index fund investing. Instead of trying to pick the winning stocks, which is like trying to find a needle in a haystack, you just buy the whole haystack. You buy a low-cost index fund that tracks the entire S&P 500. This way, you own a tiny slice of the 500 largest, most successful companies in America. You don't have to worry about which company will succeed and which will fail. As long as the American economy continues to grow over the long term, your investment will grow with it. This strategy requires you to do something very difficult. It requires you to do nothing. When the market crashes, and it will crash, you don't sell. You don't panic. You remember the person walking up the hill. You remember that every single past crash has been followed by a recovery and new all-time highs. In fact, a market crash is the only time when people run out of the store when things go on sale. If you can master your own psychology, if you can ignore the noise of the yo-yo and focus on the long walk up the hill, you will not only build tremendous wealth, but you will also buy yourself something even more valuable: peace of mind. The investment philosophy I'm describing today comes from a book that is often called the Bible of financial independence. The book is The Simple Path to Wealth by J.L. Collins. This book began as a series of letters J.L. Collins wrote to his daughter to teach her about money so she wouldn't have to worry about it. It is written in plain, simple English. There is no jargon, no complicated charts, and no sales pitch. J.L. Collins breaks down exactly why the stock market is the most powerful wealth-building tool ever created, only if you treat it correctly. He explains why index funds are the superior choice for 99% of people, and he gives you a clear, actionable roadmap to financial freedom. If you are paralyzed by market timing anxiety, if you have cash sitting on the sidelines, or if you are paying high fees for an advisor who is underperforming the market, you need to read this book. It will give you the confidence to take control of your financial future. Remember, the goal isn't to get rich quick. The goal is to get rich for sure. I'm Eve, and I'm going to check on my index funds now. Spoiler alert, I'm not going to do anything. If this video helped calm your investment fears, please give it a like and subscribe to the channel. Let's build a community of confident, long-term investors. And if you've read The Simple Path to Wealth, let me know your biggest takeaway in the comments. I'll see you in the next episode.